Raising capital compliantly sounds boring. Sometimes it is, sometimes it's not. Raising capital is fun though. Anybody how many out there, raise your hand or put in the chat if you've raised capital for a deal before, to buy a property or to fund your deal or to raise capital for somebody else, any of the above. I'm not your attorney. I am an attorney, but this is educational purposes only. So if you want some representation, if you want to ask strict legal questions you want to hold me accountable for and sue me for later, then we'll have to engage. So outside of that, we're moving on here. Why me? I look young because I'm Asian. People are like, and I wear a backwards hat, so they're like, how much experience do you have? I have a lot. I've been practicing securities law for 13 years. I've formed and built over 750 funds and syndications across $9 billion in transactions and representing $3 billion in equity raised across those transactions, either as helping my clients or as one of the partners in the deals or raising capital for my own deals. So I specialize as a securities attorney, and I'm chief legal officer for a company called TribeVest, which someone mentioned a group capital. I don't know if that's maybe TribeVest or it could be a different platform, but TribeVest used to be a group investing platform until I joined. And me and the CEO got together, whiteboard, and decided, hey, let's pivot this company and make it into a capital raising company people can get paid. So we turned it into a fund of funds company, and that's how TribeVest exists today. So we see many, many transactions across the board. We see all of the syndications and the funds that are being worked on right now currently in today's market, and it's great. I'm a former big law securities attorney. I worked at a top 3 globally ranked law firm, and now I'm the founding partner of my own securities law firm, Raise Law. We keep it small. We keep it tech enabled. We have 6 attorneys, a couple paralegals, and some administrative staff. I also host a podcast called Raise the Bar Radio, so feel free to look that up, tune in. I'd rather raise from doctors than lawyers. I have to say this because I actually raised capital myself for many years, starting in maybe 2017 up until about the end of 2022 when the interest rates spiked up and things got a little bit crazy. I took a pause. I waited to see how the dust settled. Luckily, my deals went pretty well. We had a lot of fixed rate debt, so we didn't get in trouble with the adjustable rate problems that a lot of people ran into. So we're doing well. We unloaded a couple assets, and now we're really just holding on for cash flow until the next real estate run-up, but we still have about $90 million in assets under management. But most folks like working with me because I'm not just an attorney. I'm also a capital raiser and a syndicator and a lead sponsor myself. So I come from the business side, and I can talk from that side, and I understand everybody's problems. And I don't just speak to and tell you all the things that you can't do. But given that fact, I used to raise capital because we'll be talking about your avatar and who you're raising capital from. Y'all's is probably pretty easy because you're all pretty much doctors, I think. So you're probably raising capital from other doctors. Pretty easy, not easy to do, but pretty easy to identify your avatar. But my avatar was, like a lot of people, yourself 5 years ago. It was, okay, big law attorneys, 5 years younger than me, and that's who I pivoted and told, all my marketing, sales, and advertising was towards that. Well, as you guys probably know, you've talked to lawyers, they are a pain in the ass. They ask a lot of questions. They're very skeptical. They think that they know everything. And it was tough sledding for me, to be honest. I thought it was going to be a lot easier for somebody like myself to raise capital. But, when your marketing is geared towards attorneys and you've got to have hours-long conversations with each one of them, and then they end up not investing anyways, it's tough. So I ended up actually attracting more doctors that wanted to invest with me instead because, one, they trusted me because I was an attorney or am an attorney, so that kind of checked the box for them. And B, they're smart people, and they can make decisions, and they don't sit on the sidelines. They take action. So that's what I've seen personally, raising capital. So you guys are in a really good spot. And if you want to raise capital, especially for folks that have just got started, there's no better avatar than doctors raising capital from other doctors. I mean, I have seen people just blow up that have no idea what they're doing. Not saying that you shouldn't or that you don't, but I've seen many doctors start their capital raising business, start their fundraising business, and just go through the moon. I mean, almost immediately, because you have that built-in network already of high net worth individuals that probably already know, like, and trust you, and they want to get involved in deals that you're involved in and you've invested in and that you're investing in, and it just seems to be a lot easier for you folks. Always start with your investor avatar. I won't waste too much time here, but the main idea here is that we're talking about structure, and we're going to be talking about joint ventures. We're going to be talking about debt, funds, syndications. Which one's for you? Which one works? Are you dealing in securities? Are you not? But it all starts with your avatar. Who are you raising capital from? What are they comfortable investing in? What vehicle do they understand and they will invest in? That's what it comes down to. And even when you start structuring your deal, it all starts with your avatar. Like, it doesn't start with you. It starts with your avatar. Think like they think what their problems are, about the questions that they would ask. Everything is about them. Always keep that frame of mind. And then I know when I started investing passively first because I wanted to understand that mindset. I wanted to understand how the deal worked from the passive investor mindset and from their perspective so that I could do it, so that I could present deals to my passive investors in a way that I would like from the other side of the table. Yeah, most of you are the avatar. I'm assuming, is everyone in here a doctor? Is anybody not a doctor? Is anybody willing to say, hey, I'm not a doctor out of the 5 of you? There we go. There's some transparency there. All right, I like it. Will you be raising capital from doctors, though, or who is kind of your primary avatar or network of capital raisers? Go ahead and put that in there, and I'll keep moving forward. Engineer's another good one, too. A little less of a pain in the ass than than lawyers, but still a little bit of a pain in the ass. You got to present to them the right way. Seen that happen too. You just got to know your avatar. They want to see numbers. They want to see the spreadsheet. They want to see the pro forma. They want to know the facts, typically. I know I'm generalizing here, but this is just typical. So if you're raising capital from engineers, they want the facts. They don't want the BS, which is great. As long as you identify your avatar and you know what they want, you can give it to them. So can you get paid to bring people into deals? Typically, the general rule is you have to be licensed. So you have to be licensed to raise capital, just like you have to be licensed to be a doctor, just like you have to be licensed to be a lawyer and practice law and practice medicine. You have to be licensed to raise capital. It's the same thing, unless you find an exemption. Now, there aren't very many exemptions to that in medicine and law, but there are exemptions in raising capital. One of those exemptions are if it's actually your deal. So if you're a GP or an owner operator, an active partner in the deal, you're the one buying the asset, you're the one running the fund, you're a GP, you're an owner operator. So you have an exemption. The other exemption is kind of not really an exemption, but you can come in as a limited partner. So you can invest in these deals passively as an LP. Many of you have done that before. The reason this is in the how to bring people into deals and getting paid for it is because if you create what's called a fund of funds, like I mentioned before that we do with TribeVest, the fund of funds actually comes in as a limited partner into that lead sponsor's or that operator's fund or syndication. So it's a way to raise capital into your own kind of mini fund and then invest passively in somebody else's deal. Securities framework, again, registered. You either have to register it as a public offering and think of like a stock IPO. We're talking about the same thing here. Or you have to be exempt. So you have to find one of those exemptions to be able to raise capital, not only as the person raising capital, but also as your actual deal. So your deal exemption is probably going to be a 506B or 506C deal. Y'all have probably heard about that. There's also other exemptions that you can file for, Reg A+, Reg CF, crowdfunding. There's some others that are lesser known and lesser used, but for our purposes, 506B and C is really where it's at. Typically with a 506B, you're going to get your investors that are buddies for B, people that you already have a pre-existing substantive relationship with. And the reason is because you want to bring in non-accredited investors. That's the big plus side for a 506B, is you can bring in up to 35 non-accredited investors into your deal. But the downside of that is that you're not allowed to solicit, advertise, market, anything like that. You can't talk about it on Facebook. You can't run meta ads. You can't go to a real estate meetup or one of your meetups and talk about it in front of strangers. You have to keep it. It's one of those, what we used to call the country club deals. You used to have to know somebody to be able to invest in those deals. This is that exemption. But you can bring in non-accredited investors into this type of deal. And that's okay, up to 35. But again, you can't really talk about the deal. So what makes somebody accredited? Well, $200,000 in income, over the last 2 years with a reasonable expectation of the same, $300K if you are married between the two of you, or $1 million in net worth, excluding your primary residence. So equity in your primary residence does not count towards that $1 million. And there's some other exemptions as well. You could be licensed with a Series 7, 65, or 82, also considered accredited. And the reason I'll go over that is because 506C only allows accredited investors. So if we file for that exemption, you have to only allow accredited investors, and you have to verify that. So if you're raising capital under a 506C exemption, then you have to verify that those folks are indeed accredited. Typically, you'll get that from a letter from their attorney, CPA, financial advisor, or from a third-party verification company. Well, but the plus side of that, of course, is the opposite of the 506B. It's that you can actually talk about your deal. So you can get on one of these. You can get on somebody's podcast. You can, you can go to a real estate meetup. You can you can do anything you want. You can shout from the rooftops, "Hey, invest in my deal." All good if you register for 506C, and that occurred from the 2012 Jobs Act that allowed us to do that, because before that, private investing was limited to those country club deals, so you had to know somebody to be able to invest. Can you send, and Samantha says, can you send emails to your friends and family for 506B? So friends and family, yes, because you're not. So here's the rule. The rule is you're not allowed to solicit or advertise. And the way that you prove to the SEC if something happens that you did not solicit or advertise is by having that pre-existing substantive relationship. And that's the term of art that's used. So pre-existing, meaning pre-existing your offering or your capital raise. Substantive, which a little bit of a gray area, but substantive means it can't just be a hi, nice to know you. You have to have meaningful conversations about finances, about their financial wherewithal, if they have the ability, the knowledge to be able to invest. So if you've had those conversations with your so-called friends and family, and you kind of have an idea about their finances, and you know each other pretty well, and there's been conversations, there's been phone calls, there's been emails in the past that you can record or that you can prove or show, then yes, you can email your friends and family. And that's the point. It's a closed circle. It's not open to the public. So yes, you can email your friends and your family with a 506B, and that's what typically you'll hear people call it. They'll call it a friends and family raise, and you're working under a 506B, and you're not allowed to talk about it in public, not allowed to talk about it on social media. Has to be from people that you already know. So ways to structure a raise. This is kind of the meat of it here. There's different ways that you can structure your deal. Starting at the bottom here, because this is, I guess from simple to more complex, a little bit out of order there, but you've got your note and deed of trust. If you're just buying a property and you get let's say one person that wants to quote unquote invest, it's not really an investment, but they're lending you money. So you create a promissory note and you secure that note with the deed of trust on the property that they're going to help you finance, and you're going to do all the work and do the deal. Note and deed of trust. That's a way to raise capital. You're borrowing funds for the deal. A joint venture. So I know that Pram wanted me to talk about joint ventures. This is one of the things that people get in trouble with, because you can't just call it a joint venture because you want it to be. It's not a joint venture just because there's one or two or three investors, or other. I shouldn't say investors, because if it's a joint venture, there's actually no investors. Whether there's 1, 2, 3, 4, or 5 people doesn't really matter. If you have 2 people and one person is an active partner doing all the work, and the second person is only a money investor, so they only provide money, and they don't have any rights, so they don't have any voting rights, no decision rights, no managerial rights, and the only rights they have are actually to a return of capital on their money, that's a security. It's not a joint venture. So that's the one that gets really gray and gets people in trouble. You also have a syndication, which is a single asset security. So we put together, it's still a fund. You put together a fund, you raise capital into this entity, and you buy an asset with that same entity. If you buy more than one asset in the same entity, then we're talking about a fund. Now, if you create an entity that raises capital into it, and then instead of, let's say, buying a property or buying multiple properties, you actually take that money and invest passively in somebody else's fund or syndication. Well, now we're talking about a fund of funds. So that's the difference between these, and we'll go through each one rather quickly. Wanted to talk about this really quick, because this is This is the legal premise behind everything. Whenever you say, is it a security or is it not? And that's the question you're really asking when you say, oh, this is a joint venture. It's not a security. I don't have to worry about the SEC. This is what they run. This is the test they run. It's called the Howey test. So if you want to sound really smart in your circles, talk about the Howey test. And, oh, what the hell is that? Well, that's how you determine if it's a security or if it's a joint venture or it's something else. Is it a partnership or is it a security that you need to file a Form D for with the SEC? So here's the test. An investment of money in a common enterprise with an expectation of profit derived from the efforts of others. If those 4 prongs are all met, then you have a security. So think about it. Investment of money, that's pretty easy. So there's money exchanged. Common enterprise, both parties or multiple parties, they're all in the same, let's say, LLC. Okay, great. 3, with an expectation of profit. Did the people that put in the money expect a profit or a return on their money? Probably pretty easy. Number 4, here's the big one, derived from the efforts of others. So not you. So if you invested money or you put money into this common enterprise, into this LLC, and you are depending on the efforts of others, not yourself, then we've got a security. Now, if you're depending on yourself and your efforts and your voting rights and your managerial rights and your decision making and the active decisions that you make and you do, then now we're talking about you being an issuer, you being the active partner, you being the GP, and it's a security, but you are not a passive investor in that deal if there's no other, if there's passive investors involved. JV Trap kind of talked about this, but your partnership might not be, or might be a security, right? A real joint venture, every partner has real authority. They have decision-making, they have managerial rights, they have voting rights. They are actively doing things within the LLC or the limited partnership or the joint venture, however it's structured, hands on the wheel, decisions, management, profit from your own efforts, not the efforts of others. Well, I should say, not the sole efforts of others. This guy's security, one partner brings only money, passive partner, no real control, can't veto any rights. The other person who's actively managing can sell the property and doesn't have to get the approval of the other money partner. Well, that's probably a security. They rely on you, the active partner, to produce the return. Howey prong, 4 hits, it's security. Promissory note, deed of trust. Y'all probably know about this. You've bought houses before. Kind of the same thing, except we're talking about maybe an investment property. You find an investor, wants to lend you money. You set it up with a note, a deed of trust. This can also be a security. So just because it's a debt doesn't make it not a security. It can still be a security. I would say if you're doing, and this is really gray, this is one of the really gray areas, but if you do it kind of one-off, one property, one investor to lender, you're probably okay, right? You're okay. But if you do it multiple times, many times a year, across multiple deals, or you have a lot of different quote-unquote lenders that are loaning debt, or loaning money to you and for a single deal, it starts to look and smell and taste more like a security, and it probably is, and you probably need to file a Form D. Syndication, one sponsor, one deal. You know, you've got GPs, you've got LPs, you're buying one asset. That's kind of the key. Syndication is still technically a fund. You're raising capital, you're aggregating capital into an entity, and you're buying one piece of property with it, or you're buying one business with it, whatever it is. It's certainly a security because you have passive partners providing money with an expectation of a return on that capital based on the efforts of you, the general partner. So you do need to run it under a 506B or a 506C exemption. Fund, very similar to a syndication, except there's multiple assets. That's really the only difference. You're buying more than one property. You're investing in more than one business. You're providing a lot of different debt instruments out to different companies and businesses, or for people that are buying real estate. So there are many different types of those funds. There's blind pool funds. There's semi-blind pool funds. There's a million different ways that you can structure it. They get much more complex, as you can imagine. And if you're sitting in the passive investor seat, you just need to make sure you know what you're getting yourself into with that, because there can be lots of complications that come up. Fund of funds. This is kind of the new kid on the block. It's not that it's a new structure, but it's a new application for the structure. So it used to be only in private equity and hedge funds and things like that, where you had feeder funds. Well, now, because people got in trouble for abusing what we call the co-GP, where people were raising capital and calling themselves an active partner in a deal when actually they were not, and they were only raising capital and they're getting paid based on how much they were raising capital, which is completely non-compliant and illegal. People started getting in trouble for that a few years ago. So people switched gears and said, well, how can we raise capital for other people's deals in a compliant legal way? And that way is fund of funds. Now, that ends up being expensive, right? Because a fund is exactly what it sounds like. It's a brand new fund that you have to set up. So you've got to hire me to set that fund up. I'm expensive. You've got to find a CPA that knows funds. You've got to set up an investor portal. You've got to file for your LLC, get an EIN, open a business banking account. You got to do all the things that the lead sponsor used to do for you as a co-GP. Now you have to do it yourself, and it's not only time consuming and complex, but it's expensive. So there are companies out there like TribeVest that now have made this their business, and we put the complete package together for you for a much more economical rate, and it's much less complex because we've done it all. You don't have to go out and find a securities attorney and find a CPA and open a business banking account and find a fund administrator. You just engage with TribeVest, and we do it all for you, and you can focus on raising capital. And that's actually where we've seen doctors and lawyers and engineers and anybody that has a network of high net worth individuals in their atmosphere already have a lot of success really fast, because they can engage with TribeVest. Costs $5,000 to start up instead of, let's say, $25,000. They can raise $500,000 or so and get paid. Basically, you'll make about 10% of whatever you raise, just kind of a baseline. So if you raise $1 million, you can expect over the lifetime of the deal to make about $100,000. That's not bad. Well, there are people out there. One specifically I'm thinking of that raised. Some of you may already know him, but he raised $40 million over the last 2 years. So he's collecting a 2% fee on that $40 million every single year. And then in totality, when some of these deals start exiting, he'll end up with a baseline of more than 10%, probably around 12 to 14% of that capital raised. He just built a hell of a business in 2 years, really, really quickly, scaled really quickly. And probably the top 4 fund of fund managers that I've seen are, no surprise, they're doctors, because they just have that network already built in. 1940s Act traps. I don't want to go into this too deep, but when you do a fund of fund, you're not just dealing with the 1930s Acts, which are the 506B and C exemptions that I talked about, but you're dealing with the 1940s Acts. So they do get much more complex from a securities law standpoint. We're talking about the Investment Company Act, the Investment Advisors Act, and just know that those are 2 more things that you're going to have to find exemptions for if you do a fund of funds. And again, TribeVest helps you navigate that. How to actually decide how much are you raising, right? Like, is it, are you raising $50,000 or $500,000? Well, you're probably not even going to be able to do a syndication or fund because it's just going to be too expensive. It's just not going to make sense to hire a lawyer and do all those things if you're raising $100,000. But if you're raising $1 million or you're raising $5 million, well, a securities attorney, at least like a boutique one or maybe a small regional firm, it's going to be a drop in the bucket for the expense, the money that the fund is actually going to make on the deal. So it makes sense to engage with counsel and do a fund and do a syndication and make sure that you're really buttoned up. From the fund-to-fund aspect, like I said, TribeVest made it really inexpensive to do that at $5,000, where typically it would cost you like $25,000 or so when you add it all up. You can do it for $5,000, so it starts making sense whenever you raise about $500,000. So you can raise capital for somebody else's deal, raise $500,000, get paid 10% over the life of the deal, and just keep doing that over and over and over again, and it really starts making sense as a business. The big question is, who are your investors? Are they accredited? Are they non-accredited? Do you have to raise from friends and family to begin with only? Well, if that's the case and some of them are not accredited, there's only one option. You have to do a 506B. And if you do a 506B, you're not allowed to solicit and advertise. So you can't run Facebook ads to bring in cold traffic. You can't talk about your deal on social media, those types of things. But if you can limit yourself to accredited investors only, which is actually an advantage because non-accredited investors tend to be a pain in the ass, I'll tell you that, because by definition, they probably have less money. So you're taking maybe $50,000 out of the $75,000 they have saved. So guess what? They're going to care a lot about that $50,000. So they're going to ask a lot of questions. They're going to want constant updates, and understandably so. I'm not saying that that's not right, like understandably so, but just know that you're going to be dealing with those types of things as compared to accredited investors that are a little bit more financially well off, and they're investing in multiple deals across multiple sponsors, and they've kind of been down this road before. So 506B versus 506C really comes down to who your investors are, if they're accredited, if they're not, if you want to advertise, or if you don't.